when you're going to do these multifamily deals, a lot of guys are betting on growth, right? So there's two strategies. You either have a cash flow and income model, or you have what I call a boom bust model. Boom bust, obviously the coastlines, California, the Eastern Seaboard, and then the Sunbelt markets. Those are boom bust markets. When you look at 2008, they boomed up until 2008 and they totally busted out. Even now, you're starting to see major cracks in pricing in those markets. If you look at very recent CoStar reports on rents, those Sunbelt markets and the boom bust markets of the coastlines are already seeing declines in rent rates already, just in the last 4 months. So it is a boom bust market. And so because this looming recession, those markets are dependent on population migration and job growth. Well, if there's a recession, that's going to impact that migration. It's going to impact that job growth. So a lot of guys just said, I'm going to buy this asset. It's in the path of progress. I'm going to take 30% of it. I'm going to give 70% to LPs, and I'm just going to manage it and watch it go up. Well, what if it doesn't go up? What if the population migration doesn't happen? What if the job growth doesn't all happen? Okay. That's a little bit like Columbus. So we're in that market. That's a boom market right now because of Intel and Honda, major companies that are there and growing. What I decided to do was say, you know what? I'm going to do what I can control. I can't control the great wide open market and what's going to grow. What I can control though, is taking a C or a B class property that hasn't been updated in 10 or 15 years. Maybe that's still owned by the original developer 40, 50 years ago. This is a lot of what we've bought. And I'm going to go in and I'm going to full turn every unit, meaning brand new flooring, brand new paint, brand new trim, full new kitchen, stainless steel appliances, full new bathroom. I'm going to update the commons. I'm going to add LED lighting. I'm going to upgrade the courtyards, the landscaping. And I'm going to take an asset that I could buy for maybe 50 to 80,000 a unit, depending on the market. I'm going to drop in 8 to 10,000 a unit, but most of the money is going to go in the unit. So the unit's going to look brand freaking new. And then I'm going to be able to raise the rents by sometimes $300 to $600 because the product is better, not because the market is better or the prediction of the market is better. It's because the physical living space where the resident is residing is simply better. And we've done that. We've taken units that I just bought a building called Stewart House. It was a $16.3 million acquisition. We did that May 1st. The average blended rent at that time was $650. We already have leases on our books now for $1,025 in 5 months.
That's incredible.
Because the unit is there and it's much better. So because of that, and because we're not fee-ing our construction costs, we end up keeping significantly more of the equity, which also means we keep more of the cash flow. It also means, Chris, that we're literally pushing a boulder uphill, literally forcing the appreciation in 2 years or less. When we buy a building, we want to get out of it. We want all our construction done in 2 years or less. And in that building, we'll be all in for about $19 million. It'll be worth $27 million by the time we're done. And we've forced the appreciation. So those limited partners, now they all have a piece of that $7 million of equity. And it didn't take me 7 years to get there.
And you're also not relying on the boom bust strategy where, you're relying on the market to bring the appreciation up. You're forcing the appreciation through what I would say is just an insanely difficult process of renovating. And that would bring me, there's two things I want to hit because some people on the audience don't understand A, B, and C, apartments and how those differ. But the other thing, like when you're talking about how you're renovating all these units, the first thing I cringe, literally I get goosebumps when you said that. How in the world, in this economy, in this market, are you finding enough people to actually do that kind of work? Because you talk about pushing the boulder uphill, dude, that's like the unaccomplishable right now. Finding good help to renovate that many units. How?
Yeah, well, the structure is important. So first of all, we brought a guy in to be our VP of construction that's got 35 years of commercial construction experience that comes with a tremendous Rolodex, let's call it. He's got contacts in every trade, carpentry, roofing. And he was a friend of a friend, right? So we knew him well. So that's key. So I when I looked at this model and really growing it, right? And then we needed to bring in better leadership. That was our number one objective. Bring in better people, bring in a better person that already knows how to do this. It wasn't me going to figure it out, Chris. I'm terrible at construction. I've lost money on lots of residential properties that I tried to do myself, and I always got screwed by a contractor. And so one is, if you look at Dan Sullivan's recent book, Who Not How.
I love that book.
Favorite. That's exactly what that was. Who can we hire to manage $5 million of CapEx? Not how do I do it? Who can we hire? So that was the first thing. Second thing is, Chris, it's actually a little easier when you buy bigger buildings. Not a little easier, it's a lot easier, because the tradesmen, the contractors love to just show up at the same job site every day for 6 months or a year, and to be fairly paid, but to know they have consistent work. They're not having to jump around from building to building and go search for their next project. So these guys don't leave. They come on site. We have the same group of subs, the same 4 subcontractors for like 3 years now. They're like, okay, we're almost done with these 10 units. Can I get 10 more? They love it. Third thing is, when it comes to the materials, we've almost never had a supply chain problem because we're buying so much of it. We're at the top of the pyramid, right? So when Lowe's, Home Depot, Menards, any kind of major supply house, National Design Mart, all these different companies we use, when they're like, hey, the Freeline guys want to buy 50 refrigerators, or 50 stoves, we got to make sure they get it, right? I'm not going to buy 1 or 2. I'm buying a Comex box full of crap, right? So those are major things. And then, so it's actually easier for the subs. We brought in the guy that was the leader that already knew some of the subs, and he was actively able to recruit more when he didn't know people. He was able to kind of cast his net out there and get more folks. And then we also supported Dave, our VP of construction, meaning we brought infrastructure. We brought in somebody to do all the construction accounting. We brought somebody else in to be his basically right-hand man to inspect units. And I go in the field, Chris, this is a key part of running construction. I go in the field and secret shop my properties every week. That's why it's in Cleveland, where I live. Mm-hmm. So I can show up unannounced, talk to maintenance guys, talk to contractors, talk to the subs, talk to the property managers. They don't know I'm coming. A lot of times I get up, I work out. I still haven't even showered yet. And I go get in my Escalade and I go to one of our buildings and I show up unannounced. And so that I can really see then what the hell's really going on, versus if I'm an investor from Ohio and I'm investing in Phoenix, like I can't just go secret shop that property, right? So those are some of the keys: the people, the systems, the materials. Doing more is actually easier than doing less. And then being local to the deal to secret shop it. Those are all different strategies I've used to help us manage such a big project.
That makes sense. And then real quick, just for the audience, for those that don't understand A, B's, and C's, could you just give a quick 30-second lesson on that?
Yeah, for sure. A, pretty simple, usually is brand new construction or within the last 10 years, usually in, A class or B plus type suburbs, but relatively new construction. B class is going to be built usually between the 1990s and 2010, somewhere between 10 to 30 years old. C class is going to be anything pre-1990. We buy a lot of 1960s, 70s, 80s vintage. That's when they were built. So the bones are great, but they haven't been updated. Chris, to give you an idea, like that Stewart House deal I just bought, we had a hell of a time getting insurance for it. Not because it was in bad condition, but because we bought it for $16.3 million and the replacement cost is $42 million. So the insurance companies are like, crap, I don't want to insure this thing for $42 million. So it's that type of asset, that type of product is perfect in this environment because it's workforce. Everybody can afford it. A teacher, a nurse, a doctor, a janitor, somebody that works fast food, somebody who's a waiter. Anybody can afford $1,000 a month. That's why our apartment buildings stay full.
Absolutely. All right. And the reason I wanted you to explain that is I want to focus solely on B's and C's. And I want to take the audience on a little bit of a history journey because, everything that's happening in the markets right now, whether or not you are paying attention to it or you're just completely ignoring it, we're headed the wrong direction for what most people think. Most people think things are going to get better. They're going to get a lot worse. We're in a recession. It's going to keep getting worse. Stock market's going to keep selling off, contrary to what's happened the last couple of weeks, which can only, to me, make any sense if you understand 1929 and what happened right before the Great Depression, because the same bullshit was going on back then. Markets are going up when there was no fundamental reason for the markets to go up, just like they are now. The reason I get into this is because if you're looking at where to put your money and you're looking at how to hedge or get ahead of this thing and where the real opportunities are, I got bad news. They're not the fancy brand new built apartment buildings that have high rents that, the pro forma shows an increase in rent and an increase in appreciation. The value and where you want to be are B's and C's, because that's where people, I love how you called it the workforce. That's where the people that actually rent can afford to live. And with the housing pricing being what it is, and now, the Fed doing a fantastic job of raising interest rates incredibly fast, so fast that people can't even fathom how much mortgage rates have gone up. People can't afford houses. So guess where they got to go? To apartments. But there isn't enough apartments, or the apartments are out of their price range because they could buy a house for less than they can afford rents. So your model, B's and C's, is so perfect for what we're about to see, which for some is going to be one of the biggest market meltdowns and biggest tragedies in their financial life. And for others like you, it's going to be one of the greatest opportunities of your lifetime. So can we just talk a little bit about how people can participate in this and how syndication models allows people that maybe couldn't buy a $16 million property to actually have ownership in it?
Sure. Well, syndication is very common. Let's start with that. President Barack Obama signed into law the Jobs Act back in 2011, I believe it was. And the Jobs Act allowed investors to create a federal securities exemption where you did not have to be a broker dealer to sell securities, and you could openly market those securities to the public, what's called a 506C federal securities exemption. Now, all the way back to 1934, right after the Great Depression, the original securities laws were created, Securities Act of 1933 and 1934, and that created 506B, which also allowed investors and operators to create a securities exemption where you didn't have to be a broker dealer, but you could sell securities. You just had to have this exemption. So 506B has been around for 100 years. 506C has been around for 10. And what it basically does is allow someone like me to sponsor a deal. Say I buy a property. Let's take Stewart House, $16.3 million. I'm going to do about $2 million of construction, soft costs. Let's say I'm all in for $19 million, make it nice and round. Well, the bank's going to give me about $15 million, about 75%, plus some through a draw process to cover construction. But I'm going to be short about $5 million. I could come up with the $5 million myself and say, okay, I got to stroke a check for $5 million. Or I could syndicate the $5 million, which basically means I bring in a pool of investors, a group of investors. And what we typically do is break those off into units. So $5 million, that's 50 units or 50 buckets worth $100,000 each. So each 100,000 is one unit. Then what we do is we say, okay, each person that invests is going to own equity in Stewart House Apartments. And by their equity ownership, they are now going to get what's called a preferred return, okay, which means in the stack of capital that has to be paid out from the operation, we obviously have to pay the expenses first, the real estate taxes, the insurance, the utilities, et cetera. We have to pay the bank. Obviously, the bank's not gonna allow us to not pay them, so we have to pay the bank.
Numeral uno.
Yep. Then the limited partners or the investors, those 50 investors, they get paid next before I take any money out of the cash flow. So that preferred return, we typically try to target somewhere between 6 and 10%. Every deal is different. We've done a lot of deals at 10, several deals at 6, some deals at 8, which means if you got $100,000, you're getting, let's say, 10% return or 10 pref. It's not a guaranteed return. It's a preferred return, okay, which means you're going to get paid before I get paid. And that's $10,000 a year, paid out $2,500 a quarter. Pretty simple. So now instead of, like Chris and I talked at the beginning of the show about, the large cap stocks, S&P 500 getting a 9% return or a blended getting a 7% return before tax, this is paying $8,000 or $10,000 a year very consistently, and it's just coming out of the cash flow from the rent. So it's very predictable, you can kind of see it on paper. It makes a lot of sense. It's not like trying to read a pro forma on Facebook stock and how does Facebook pay out its investors? Nobody knows. So it's very easy to understand. There's cash flow coming in. We're going to bump the cash flow up by turning the units and raising rents. We're going to have more cash flow. Then on top of the preferred return, limited partners also get a piece of equity in the deal. Let's just say it's 1%. Well, that 1% means they get 1% of everything, 1% of the refi proceeds, 1% of the cash flow over and above the pref, 1% of the equity. So the target for guys like me is to make sure our limited partners are projected to get somewhere between a 20 to 30% annualized return when you pile all that together. The cash flow, the refi proceeds, the equity, you dump it all together. And let's say we have a time frame, Chris, of 4 years. And at 4 years, we're going to refi. That's called a recapitalization event. So at the recapitalization event, we now add up how much cash flow did you get, how much pref return, how much refi proceeds, and how much equity now do you own? And we want that to be somewhere between 20 to 30% annualized return. So if somebody throws in $100,000 and they're getting a 25% annualized return, that's 25% in year one, 25% year two, 25% year three, 25,000 year four. And now they've got $100,000 of total gain on top of their $100,000 of principal. Okay. And we now could sell the building and unlock all of that. Maybe we refi it. We return maybe we return the principal and some of the equity. But they have that on their balance sheet. They have that on their income statement that now they have all of that to work with versus, hey, I'm going to throw the money in the stock market, earn 7, 8, 9. It's going to be highly volatile, up and down. Like, who wants to buy Facebook stock right now when Zuckerberg is betting on the metaverse? Who the hell understands that? Right? Versus what I just described.
Yeah, I think people understand, it's a property. They've lived in apartments or know somebody that's lived in apartments. It's logical. I think a lot of times stock market is based on emotional based investment decisions. And those emotions are very quickly dissipating because they're watching those emotions evaporate when the returns are going down or actually they're losing money. So, this is just logical thinking. We all can logically understand an apartment complex. We can logically understand an old unit that was built in the 70s, remodeled to a new unit and rents costing more. It makes perfect logical sense. And you all know how the debt stack works, right? You got the bank comes in and there's some extra money that needs, to be put in to do the renovations and to buy the property. And then this syndication model, this pool of people come in and that's how it's done. So there's nothing complicated about this at all.